myself Bharat Pimple. Today's we are discussion on ratio analysis. Ratio analysis is an important tools for analysis of financial statement. Under ratio analysis, various types of ratio are calculated between the different items of financial statement for estimating the financial decision and financial position of any undertaking and the basis of ratio. Ratio is specific conclusion are drawn. The ratio analysis means relation between two numbers of which one is numerical and another is denumerical is generally indeed ratio. Ratio analysis, various classifications of ratio analysis. Firstly is traditional classification. In traditional classification, profit and loss account ratio, balance sheet ratio and mixed ratio. Second is classification by importance. Classification by importance including primary ratio and secondary ratio. Third is classification by users. Classification by users for management, for lender, for shareholder. Management, in management, net profit ratio, operating ratio, gross profit ratio, stock turnover ratio, solvency ratio, reserve capital ratio, return on capital ratio. Second is for lender or creditors ratio, solvency ratio, cash loan service ratio, loan debit equity ratio, current ratio, liquid ratio, creditors turnover ratio and fixed asset ratio. For shareholder or investor for their investing in business, dividend per shares, income per shares, dividend received ratio, capital gearing ratio and debit equity ratio. Next, classification by purpose or functions, profitability ratio, turnover ratio and functional ratio. In profitability ratio, which ratio is including in the profitability ratio? Gross profit ratio, net profit ratio, operating ratio, operating profit ratio, expenses ratio. Turnover ratio, debit turnover ratio, credit turnover ratio and financial ratios, short term solvency ratio and long term solvency ratio. Now we are discussion on profitability ratio. Profitability ratio means the main purpose of any business undertaking is to earn profit. Earning of profit is essential to exist the business and for long term development. Actually, the existence of undertaking depends on its earning capacity. Hence, every business undertaking try to earn maximize profit by the optimum utilization of the availability source and its earning capacity. It's called profitability ratio. Then gross profit ratio is part of profitability ratio. Gross profit ratio, it is called as gross margin ratio or trade margin ratio. The gross profit come after deducting the cost of goods sold from net sales. Gross profit has the special importance in business. From it, the earning capacity of the business can be measured. This ratio is specially useful for the measuring the profitability and management skill of the business. The formula of gross profit ratio, gross profit is equal to gross profit ratio is equal to gross profit divided by sales into 100, that is gross profit ratio. All the director charges means the expenses relating to the purchase. The gross profit ratio is overall profit of the business. Secondly, net profit ratio. Net profit ratio This is the ratio present the relationship between the net profit and net sales. The net profit ratio, the indicator the management has operated the business skillfully and after setting aside of all business and expenses of the payment. Net profit ratio, formula of the net profit ratio, net profit divided by sales into 100. Next is operating ratio. Operating ratio means the ratio is calculated in the between total operating cost and net sales. Hence, operating expenses means the total of cost of sales and operating expenses. Formula of the operating ratio, operating cost divided by sales into 100, that is formula of operating ratio. Next is operating profit ratio. Operating profit ratio, it is also called operating income ratio. This ratio also called operating income ratio. By this ratio, the net operating rates on sales is measured. The formula of operating profit ratio, operating profit upon sales into 100. This ratio indicate relation between the operating profit and sales, that is called operating profit ratio. The problems on ratio analysis. Firstly, we show gross profit ratio. Gross profit is equal to gross here is gross profit is given 90,000 rupees and net sales given rupees 3 lakh. Now we use formula gross profit ratio is equal to gross profit divided by sales into 100. We calculate the gross profit ratio is equal to gross profit is 90,000 divided by total sales of business 3 lakh into 100. Total gross profit ratio is 30%. The answer of gross profit ratio. Now we calculate the net profit ratio. Net profit ratio is equal to net profit upon sales into 100. Here is given net profit is 35,000 and net sales is equal to 3 lakh. Now we use the formula of net profit ratio. Net profit ratio is equal to net profit 35,000 divided by 3 lakh into 100. Answer of net profit ratio 12%. Now we calculate the operating profit ratio. Operating profit ratio is equal to operating profit upon sales into 100. Now we including the figure in formulas. Operating profit is given 36,000 and net sales given 3 lakh into 100. Total operating profit is 12%. Lastly, we have discussed on profitability ratio. Again we discuss on profitability ratio. First discuss gross profit ratio. Gross profit ratios formula: gross profit ratio, gross profit upon sales into 100. Second, net profit ratio, formula of net profit ratios: net profit upon sales into 100. Third, operating ratio, formula of operating ratio: operating cost upon sales into 100. Last is operating profit ratio, formula of operating profit ratio: operating profit upon sales into 100. Thank you.